Hi everyone, this video is the next one on the strategy and it goes as what to hedge. And in this topic I want to consider a simple numerical example, but that sometimes reflects the reality of business for a large number of companies actually. Okay, let's move on. The topic is what to hedge. What to hedge. And obviously, if to hedge. Always keep in mind that question, if you need to hedge. And if you don't need to hedge, please don't do it, because you might end up in the situation where you spend a lot of time and resources on unnecessary activity. And it also costs a lot of money as well. Okay, let's have, as an example, the group of companies with the parent here. Let's call it company P and subsidiaries here, company S1 and comp S2. Simple group structure where you have one company on top, two companies are wholly owned subsidiaries of company P. What's noticeable about these guys is that parent receives revenue in United States dollars and subsidiaries are cost centers. This one is in euro and this one is Great Britain pounds. Simple group. Euro, Great Britain pounds, United States dollars. This generates revenue. These are cost center. Let's assume that our costs and revenue are predictable, like really reliable prediction for revenue. Cost of, I don't know what's happening with me today. Cost of goods sold, operating expenses, other, and net income. And as we assume it's simple, it's also free cash flow. Free cash flow here. Okay, for parent company, for P, it's gonna be 1,000. Let's make it more interesting and more natural. It's not 1,000, it's 1,000 million. So it's $1 billion. Cost of goods sold, let's assume 100. It's our Amazon Web Services, for example. For OPEX, let's assume another 100 here. When we have subsidiary 1 and subsidiary 2, and for subsidiary 1, we don't have any revenue, as well for subsidiary 2, we don't have any cost of goods sold. These two guys are providing to parent some services. Let's assume engineers sit here in UK and in, I don't know, and in Germany or France. So one is in euro, another one is in Great Britain pounds, and it's OPEX. In euro it's gonna be 400 million euros. In Great Britain pounds it's gonna be 200 million Great Britain pounds. Okay, let's consolidate these guys in our management accounts because it's forecast. This is consolidated. And as we have our functional currency here as United States dollars, we will consolidated in United States dollars. Let's assume our planned rate here is 1.2 average for the next year and 1.3 average for the next year. Okay, consolidating. $1 billion revenue, cost of goods sold 100, OPEX 100 plus 400 multiplied by 1.2 plus 200 multiplied by 1.3. It's 840. I've calculated it before. I'm not doing it like now live. So our net income 60. I mean, I've seen this picture a lot of times. It's more or less the reality. With that much of revenue or cash inflows, you might end up with 60. So it's net profit margin of 6%. It's usual for the businesses that are growing really fast or for very stable businesses. Sometimes it even might be negative. Okay, what might go wrong here? Obviously, anything. This is real business. In real business, anything might go wrong. But if you consider foreign exchange risk, this is not settled in the stone. This might change. This is just only your prediction. How badly this might change? Okay, let's play a bit. Let's have scenario analysis. Let's assume average euro to USD will be something like, I don't know what the best here. Okay, let's assume it's going to be 1.3 as average. It sounds unrealistic as of April 2026, but believe me, it might play out in some scenarios, having this unpredictable environment. What will happen if Euro-USD goes to 1.3? That means that your 400 should be translated at 1.3 rate instead of 1.2. So it adds to your OPEX additional 400 multiplied by 0.1 or 40 million United States dollars, because we multiplied 400 euros, 400 million euros at the change of the rate. So it's 40 million euros, $40 million. And that changes the whole picture. Now instead of 60 as a net income, you will have 20 as a net income. Okay, what about GBP to USD? If it goes to the wrong direction, and by wrong I mean wrong for you, as you're anticipating something, and it goes in another direction, you will end up having additional OPEX here as well. It's 200 multiplied by 0.1. So additional $20 million. If you sum it up, it will give your profit 0. This is a dramatic change. And this is real. I mean, even if the rate is not 1.2 today, it's something different. I mean, 10% fluctuation for the rate during the year is something we've seen last year and many times before. In 2022 it was the same situation, the rate changed dramatically and a lot of businesses suffered. Not only like this structure, but many other structures and many businesses that have significant broad operations. And by significant, you're deciding on yourself what is significant for you, but this one is obviously big. If you have all of your cost of goods sold and all operating expenses as 96% from your revenue and 48 something, I'm not sure if my math is correct, but more than 40% in euro and more than 20% in Great Britain pounds, that's a lot. That's what you should consider, and that's what you should probably think how to protect your business from. Okay, what you can do? You can buy forward contract here. You can buy forward contracts for the whole 400 million euros and 200 million Great Britain pounds. How much will it cost to you? In current environment, 1 year forward contract to Euro USD cost you 200 basis points. 200 basis points, what is it? It means if the rate today, can you see it? The rate today 1.2, you might buy the contract at 1.22 plus 200 basis points, 200 BPS. Yeah. What is the total cost of it? It's $8 million. Total cost of 200 basis points. But if you will see, if you look at the average for the year, it's not going to be 200, because the first contract with expiration in 1 month will cost you just a bit, probably 10-20 basis points. Second month will cost a little bit more. Third, fourth, 6 months will probably cost you 100 basis points, and 12 months will cost you 200 basis points. Okay, so in average, you will pay average a fixed hedge cost. It's going to be 150 basis points or $6 million. $6 million to hedge 400 million euros. For Great Britain pounds in current environment, it will cost you nothing because the rate differential, have a look at my video on interest rate parity. Interest rate differential for Great Britain pound and United States dollars, it's almost nothing, so it will cost you nothing to protect at current rate. Okay, in total you will pay $6 million, and that's also a lot. I mean, 6 million from 60, it's 10% from your net profit margin. But it will protect you against any moves in foreign exchange rates. But here you will not be able to participate in favorable moves. If the rate will go into your direction, let's say euro will move to 1.1, you will still have to obey to the contract at 1.2 because this is binding contract. That's what you are signing on. Then you jump into forward contract. But you have other options. You can buy an option, or you can jump into collar agreements to make your option cheaper. A couple of words about the option. Option contract will cost you normally about 2% from your total, and 2% from 400, it's 8 million. And here's also going to be about 2%. So it's another 2 million. It's kind of the same as you end up paying with your forward contracts, a little bit more for the optionality. The great difference here is that you have to pay the options premium upfront. So this is the real cash outflow. Okay, let's summarize a bit. I will clean this part. And summarize an options that you have. Okay, what to hedge? You have great exposure in euros and in Great Britain pounds, totaling more than 60% of your expenses, or 50%, or whatever you think as considerable, as material. So you probably would love to do something about this. What you can do to protect your business from adverse or favorable foreign exchange rates fluctuations? We forgot to speak about this one. You can go with natural hedging. It's not that simple, but basically you might start selling in local currencies of these subsidiaries. We call it natural hedging. Natural hedging. For some businesses it's simple to do. For other businesses it might be difficult and it might take years to restructure the business. Second one, hedging. And in hedging you have forward contracts, we already discussed, binding contract, you protect yourself against adverse movements in foreign exchange rate, but you cannot participate in favorable movements. And you don't have to pay anything in advance. That's the beauty of forward contract. Options. You're buying flexibility. You're buying an option to participate in favorable foreign exchange rate movements in the future. If the rate goes to 1.1 from 1.2 here, you're just letting your contract lapse and you go and buy at the spot market. If the rate goes to 1.3 from 1.2, you then exercising your option contract and go with the rate 1.2. But you have to pay here 2% from the total exposure upfront. 2% is not exact number, but is for you to have a sense approximately how much might it cost. And another popular instrument is collar. And collar is a combination of two options. You're buying a call option to have your rate fixed at some level, and you simultaneously selling a put option. And when you're selling something, you are receiving something in exchange for it. So in that sense, you are decreasing your premium, your total premium. So you receive premium for selling put option, and you pay premium to buy call option. Okay, these are the most commonly used instruments, principles to protect yourself against foreign currency exchange movements. Which one is the best? I don't know. It's management decision. This is the hardest part. This is where you have to sit and discuss every option from available alternatives. And to discuss it properly, you have to have this perspective. You have to have really solid forecast. You have to understand your exposure, and you have to model all possible scenarios, not like the full range of scenarios, but disaster scenarios, most favorable scenario, and money that you have to pay or you have to let forgo under every of types of protection. Forward, if the rate moves to 1.1, we are losing 60 million, for example. If the rate moves to 1.3 for euros, we are protected at rate 1.2. So that's how it works, and it takes time, it takes preparation. You have to sit with your stakeholders, you have to go one by one through each of the scenario, and depending on management strategy, on risk appetite, you are deciding which strategy is to follow. And that's actually the difficult part of the exercise. I would say the most difficult. This technique, it's black and white. It's that you can collect easily, you can analyze it easily, but the discussion itself, uncertainty of the business, uncertainty of the macro, very difficult, very challenging, and someone on the top, someone from C level, will have to make this decision, which way to go. It's not evident. It's not evident which will play better than others. So it's a decision. Okay, see you soon.